All right, we are talking about the Bank of Canada and inflation in this country. We'll get a fresh read of inflation come tomorrow, as I mentioned. Let's bring in Dominique Lapointe. He is the global macro strategist at Manulife Asset Management. Dominique, thank you so much for being with us. We are expecting, if the headline number and expectations are true, inflation to come in at the lowest point since March 2021. What does this mean for the rate picture going forward?
Yeah, so the reason why we're having such a low number mostly is because we've had a lot of goods disinflation, right? So energy this year, furniture, appliances, used car, of course. So that has pushed down the total inflation rates pretty quickly. Now that going forward, I think what the Bank of Canada is concerned about is these what we call base effects from like prices just no longer rising and being a little flatter, not being a driver going forward in the second half of this year. So I think even if we do get a low number tomorrow, the question is, will economic activity spending slow down in the coming months so that the Bank of Canada is comfortable that in the second half of this year, we're not going to get a rebound in these categories. And that's why, even if we do get a good number tomorrow, it's not going to be enough to pause probably in September.
There's a lot of ways to torture inflation data, as you know, Dominique. One of the things that stands out, though, is as these rates rise, mortgage costs are feeding into inflation, and we're told largely to ignore that. However, Canadians don't have that luxury. When rates rise, that is one of the biggest expenses that they are feeling immediately. Why shouldn't we be paying bigger attention to that?
Oh, we do. Actually, at Manulife, we do pay attention to these costs, and we've been flagging this. It's not an issue, but it's something that the Bank of Canada needs to be aware of, that as they raise interest rates, it does feed into inflation. And so when you mentioned, when you remove that, you get a lower inflation level. But the Bank of Canada is also right at pointing out that prices are still broadly increasing. So if you look at anything, recreation, restaurants, travel, personal care, these categories of inflation are still fast, and we don't see a lot of signs that they're actually abating. And I think that's also something that we have to be concerned about, not just the fact that mortgage interest costs are pushing up the headline number, but for sure, they have to acknowledge that if you do remove it, the total inflation is actually lower.
And what is your outlook for rates then? You think September is a go for another rate hike?
It's hard for me to have like a definite answer right now. I'd say it's 50-50. In the near term, what we need to see is actually weaker spending from either retail sales or economic activity. In the past 2 months, we saw hours worked in the labor force survey actually being pretty weak. So that's a sign that maybe the economy is slowing down. So going into September, I'd say it's 50-50. But then beyond that, you have to consider the fact that the U.S. economy will probably have slowed down a little bit. We're going to get the feedback from a weak euro area and also weak growth in China. And that will be a lower effect on Canadian GDP through international trade. That's not something we've had this year. So we think after September, there's a very high chance that they're going to be done, meaning an extended pause before they can actually enter into a rate cut cycle in early 2024.
All right, Dominique, thanks you so much for that perspective. We'll see what the number holds for us.
Well, we got more U.S. bank earnings out today. Bank of America topped profit expectations, but it was a bit of a different story at Morgan Stanley, where trading revenue fell. Let's dive more into the numbers with Gerard Cassidy, Managing Director and Head of U.S. Bank Equity Strategy with RBC Capital Markets. So, Gerard, it looked like quite a positive reaction on the markets today, but a bit of a mix in terms of the results. Maybe if we start with Bank of America, what did you think there?
The Bank of America results were quite positive relative to expectations. When you take a look at the numbers that they put up today, one of the key numbers was net interest income. And though their net interest margin fell in the quarter, as they've had to pay up for deposits like all banks here in the United States, and due to the rise in short-term interest rates, they were able to offset that pressure with higher volumes from loans as well as other earning assets. And that drove the revenue growth number to slightly better than expected. We'd also point out that credit quality remains very strong and the provision for loan losses was lower than expected. So overall, when you look at the Bank of America numbers, came in better than expected, beat
Mm-hmm.
earnings, and as a result, the stock is performing well today.
But didn't the net interest income actually miss estimates, though, Gerard, or did I misread that?
I think what you, well, at least according to our estimates, it was in line. We were in line with consensus. Now, they were lower, though. But to your point, it was lower than the second quarter, the net interest income. So, yes, they was sequentially lower, but in line with estimates.
When you talk about the provisions for credit losses, putting less aside, and it's not the only one doing that, but I wonder, do you take that as a positive that they're putting less aside, or, in terms of the read on the economy, say they think things are going to be a little bit more stable than otherwise if they were putting more, in that just in case pot?
It's a good point that you're making because it's a balancing act that all the banks have to do. Bank America, similar to its peers, in setting aside that money in the pot, so to speak, for future credit losses, they're assuming a 5 to 5.5% unemployment rate. Now, here in the U.S., as you know, the unemployment rate is well below 4%. So to get to a 5.5% unemployment rate by the end of the year is very unlikely. That being said, the provision for loan losses did increase from this prior quarter and a year ago quarter, but against expectations, it was lower. So what's interesting about the credit picture that's shaping up by the banks that have reported on Friday of last week and today is the consumer is in very strong shape. Consumer credit card losses for both Bank of America and its peers are well below pre-pandemic levels. And yes, over time, they will get back to normalized levels. But credit still is strong, which is why these provisions are coming in lower than expected.
And what did you make of Morgan Stanley? Because, you heard executives today talking about how the quarter started off different than they see it having ended, more positive ending to the quarter. Do you think that that will be, reflected in Morgan Stanley's subsequent results?
It's a good question because against expectations, the numbers were better than expectations. But to your point, against prior quarter and year ago quarter results, the numbers were weak. And they were weak because of the start of the quarter, as you pointed out, was weak in trading and investment banking. Now, they did talk probably more so than the other companies like JP Morgan, Citi on Friday, and then Bank of America today, that the green shoots are starting to show up in investment banking. And they mentioned that a number of times that the backlogs are now filling up. And it's a matter of time before we see more activity in ECMs, meaning more IPOs, and then over time, more mergers, which will lead to higher advisory revenues. So they gave a picture that the quarter started off slower, but it really had some small momentum at the end of the quarter. But now we're entering a seasonally slow quarter, which is, of course, the summertime. And so we should expect to see less activity in the third quarter than the second quarter, which is traditionally the way it's worked.
There's also been a lot of focus, Gerard, on the smaller banks in the U.S. And PNC Financial reported. What did you make of their results? Because it seemed like actually a bit of a mixed reaction in the stock price, but again, at this point of about 2%. So maybe not as strong of a positive reaction as we saw on the other ones, but what did you make of their quarter?
It's interesting because we believe going into the quarter, based on our conversations with different investors, that PNC was a stock that many investors shorted going into the quarter, anticipating that the news was going to be worse than it actually was. And so the stock is up today. They did lower guidance, PNC did, particularly on net interest revenue because of the pressure on the margin coming from higher deposit costs. And I think we're going to see this with other regional banks who really start reporting their numbers tomorrow, that we'll see this net interest margin pressure continue for the banks. But I would point out, if history repeats itself, what we've seen in the last 4 tightening cycles, is when the Fed reaches the terminal rate in Fed funds. Within 3 to 6 months, deposit rates stop going up. And then the yields or the cash flows from the bond portfolios are reinvested in higher yields, and the margins stabilize and go up. So if the Fed is finished by September, we expect further pressure on PNC and other regional bank margins in the second half of the year. However, in 2024, we could actually see up net interest margins if the Fed is finished.
Okay, well, we'll keep an eye on those as well. And Gerard, thanks so much for joining us today. We really appreciate it.
You're very welcome. Thank you.
That was Gerard Cassidy, Managing Director and Head of U.S. Bank Equity Strategy with RBC Capital Markets.
Well, when it comes to the battle on inflation, Jerome Powell and co. might have come up against an unexpected adversary, Beyonce and Taylor Swift, driving fans into a spending spree as their mega tours kick off. Not only around the world, but in the United States. There is estimates that Taylor Swift alone, in addition to bringing in more than $1 billion for her concert alone, is actually generating about $5 billion worth of consumer spending. I'd like to bring in Paul Golding. He's a senior analyst of U.S. lifestyle and payments at Macquarie for some insight. Now, Paul, you know that we've all got swept away in kind of Taylor mania and Beyonce mania. And in finance, it's always a great day when I can marry Beyonce and financial coverage. But there have been concerts for a long time. Why are we just now talking about how they're contributing to inflation? Has the nature of these shows changed?
Amber, great to be on with you. Has the nature of the shows changed? I think it's important to note that the selection of show types, sizes, the magnitude of tours, there's still significant variety and breadth across the landscape. So when we look at Ticketmaster and Live Nation, for example, Live Nation as a whole, which in our view is the best proxy for the market overall, we see that in Q3 of last year, the company noted that average ticket price was still below $35. And that, of course, spans small shows in small venues, local, and goes as high as these major international tours. What we're hearing a lot of, though, is the secondary market inflation, and that's where we've seen significant sticker shock press come out and note how expensive these tickets have gotten. If you look at some of the major tours like the Eras Tour, the primary market, which is the focus when it comes to platform selling tickets for the promoter or the artist, the sort of the first level, primary for Eras was somewhere between $49 and $499 US on average. We saw the secondary across all cities average over $2,400 US, and so is going as high as an average of $3,600 in some markets. So there's a big discrepancy there in terms of primary versus secondary, and the secondary is where we're seeing those sticker shock tickets available.
And I guess this is where you start to get regulation and politicians and people, saying that this is an unfair system. But at the end of the day, is there anything that can really be done about that?
Well, we've written quite a bit in our research about this. There's a dynamic around all-in pricing for the ticket, which in our view would actually benefit platforms in the primary space like Ticketmaster, because other platforms in the marketplace that may be trying to acquire those primary tickets and then resell them at a higher price, they may use different proportions of what the face value ticket charges versus fees at the end might be to make up the difference or to add even more on in the end, further costing the consumer relative to that primary ticket sale and what that would have been. So there's regulation that's been proposed around that. And the other piece of it, of course, is the automated nature of some of these platforms that can use bots to try to acquire primary tickets more quickly, of course, as they're automated, more quickly than humans. But in the example that I used before around Ticketmaster and Live Nation, Verified Fan, their platform to try to verify each and every primary ticket and tender, that has gone to significant lengths and been quite effective in reducing how much of this automated ticket purchasing has been happening.
We're taking a look at shares of Live Nation, which have rallied in the past couple of months, and concerts has proven to be one of those pent-up areas that people want to spend in after the pandemic, not just spend on concerts. I mean, I went to Beyonce, I had to get a new outfit, I had to book a hotel, so there's all kinds of spending on top of the 3-digit price ticket that I paid. When you look at the ancillary spending that is going up, is that also becoming more remarkable, that there's more around it?
Well, I think in gauging how much ancillary we could see, it's important to understand how many more show counts or how much more show volume we are seeing. So again, referring to Ticketmaster as a proxy, or referring to Live Nation as a whole as a proxy for the market overall, we're seeing in Q1 43% jump we saw Q1, which calendar Q1, we saw a 43% jump in the number of shows. And we saw a 50% jump in the gross transaction value of tickets on the platform. So it's not just the ticket cost that is going up. It's not just the fan count. There was a record number of fans in the period. It's not just the fan count, but it's also just the number of shows happening. And that's, in our view, what draws people to different locations, causes customers and clients of accommodation facilities and hospitality venues to spend. And it all sort of converges around the number of events that create this occasion to spend.
You cover a bunch of consumer names that have benefited from that post-pandemic sort of pent-up demand. The cruise lines, for example, in addition to these concert venues, as well as the credit card companies. It's going to be a time we're expecting a slowdown at some point of the consumer, yet you've got to buy on almost all of these stocks and sectors that you cover. Is that because you don't see a slowdown coming, or because you think a lot of these businesses will be resilient?
The latter, to the extent that these are experiential names. Mm-hmm. So as we think about the space overall, travel and leisure, and live events as an experiential live entertainment activity as well. Number one, in many cases, especially for live events like major tours, these are not commodity type events. These are very unique, and in many cases happen once in a several year span, if not less than that. So there's an urgency that drives consumption there at the expense of maybe other categories of consumption, number one. Number two, there is also, at least when it comes to some of the other names that I cover in experiential, there is a value proposition relative to land-based, given how things have progressed in cost. And so across those various categories, that's why we have the views that we have.
All right, Paul, thanks so much for all of that insight. I appreciate it. That's Paul Golding joining us of Macquarie.
Russia is pulling out of that Black Sea grain initiative, under which it was allowing at least some Ukrainian crops to go onto the global market, and it could well have a direct impact on crops that Canadian farmers grow. This is the latest Russian threat to Ukraine's agricultural exports, and of course the center of attention here is Black Sea ports. There are fears, of course, of a naval confrontation in the Black Sea between NATO ships and Russian vessels. We're joined now by Mike Jubinville. He's senior market analyst at Markets Farm. It's great to see you. Thanks for coming on the show. Let's have a look at wheat prices, because they have moved up over the past few days. Is that in part because of this Russian action?
You know, typically at this time of year, we are engrossed in a weather market. So shifting patterns in terms of the latest forecast going through the growing season always has a dramatic impact on price. But this week, especially, the intensifying situation in the Russia-Ukraine situation, that has really grabbed some headlines and influenced these markets right now.
But as you say, the weather is often the big driver, and we're getting some brutally dry conditions in parts of Western Canada and the States as well.
You know, it is certainly impacting Western Canada in particular. You know, we have very dry conditions. We've done our own Markets Farm crop tour and used provincial crop reporting analysis as well as Stat Canada satellite mapping systems. And we've been coming up with some acreage or yield estimates for Western Canada that are certainly not at the level of the disaster of the 2021 drought, but certainly compromised, especially in areas of southern and central Alberta, and that southwestern central areas of southern Saskatchewan as well are really being felt of the dryness situation.
What are the big crops in those parts of the country?
Well, it's pretty diverse. You know, spring wheat is obviously the mainstay of most crops. There's some canola in there, but the big ones are, I know one of your favorites is pasta. The Durham market is really in the crosshairs of this drought, as well as some of the pulse crops when the peas and lentils are in consideration. But it's a pretty broad swath of commodities that are being impacted prairie-wide.
I do love my pasta, Mike, and I make a point of eating it just with a fork. I never use a spoon, just to show off. Being Italian, you see. What's happening in the canola market? Can you give us a summary?
Well, you know, we have been under some significant pressure going into the springtime, coming off the extraordinary highs that we posted last year. And there certainly was a big expectation that we're going to have a very large canola crop this year. The acreage was there. Intentions were going to be maybe as much as 20 million tons of canola production this year, which is a very big crop. But again, the dryness conditions that have prevailed, particularly across the southern portions of Western Canada, but really impacting all areas to some extent, means in terms of our forecasting, we're predicting as of right now, and it's still early in the season, but a 16.5 million ton crop. So the combination of the situation and the evolving geopolitical dynamics that are going on in the Black Sea region, along with the weather issues that are impacting our market here, has driven the canola market from its lows at the end of May up probably 35% to where we are today.
That's
big. So it's been a big move.
Sorry, Mike, because that's our biggest crop some years, isn't it, canola in this country?
Well, canola and spring wheat really compete for the top shelf in terms of the largest volume commodities we produce here, at least in Western Canada. One
good, well, I don't know if you can call it good news, Mike, but a surprising bit of insight here. The port strike is obviously bad news for commodity exporters, but for the grain participants, it could be worse. It's not a huge time for grain exports right now via Vancouver.
Usually we're coming into the close of our marketing year right now, so we're just cleaning up the remainder of business that we need to accomplish from last year's production. And this year's crop, of course, is still in the ground. And if a strike were to happen, say September forward into December, when is the main big shipping period for our bulk commodities, that would be increasingly problematic. But in terms of this strike, it's affecting more the container industry than it is bulk commodities. So it wouldn't have necessarily the same impact on our commodities that are shipped by bulk shipping, since you know, a lot of that product is considered an essential service, so is not affected. But the container shipping that affects a lot of commodities like pulses certainly would have some influence there.
Mike, it's great talking to you, and thank you very much indeed.
Okay, we're back with Barry Schwartz. He's Chief Investment Officer at Baskin Wealth Management. Let's talk about some stocks that you own on behalf of clients and why. We talked about Netflix. Let's take a deeper dive into Netflix.
Yeah, absolutely. So some of these tech stocks have been incredible this year. I'm sure lots of people are asking, have I missed the run? Are they overvalued? Should I rebalance into names that I haven't done as well? Well, I think long term, I'm looking out 3 to 5 years, and I see a lot of certainty with Netflix. 238 million global subscribers, Paul. They have such untapped potential to raise prices again going forward over the long term, sell more services to their subscribers. We know for sure that they're working on high-level video games. Look at how much Microsoft paid to acquire Activision and the fight it had to try and close that deal, $60+ billion deal. Netflix wants all of your attention. And so the way they're going to get it is continuing to offer great programming. A lot of people are concerned about this Hollywood strike. That doesn't really impact Netflix. It's a global business. It makes movies and TV series around the globe using actors around the globe. And really, it's hate to say it, but at the moment, it's a benefit for Netflix because it doesn't have to outlay a lot of money for production. So we see earnings doubling in the next 3 years from here. The stock today, optically not cheap, but you look at 3 years, it is cheap.
What about the competitive landscape? A couple of years ago, it was common to hear people say Netflix's time as the only game in town is over. Disney plays in this space. Paramount plays in this space. There are other competitors that inevitably will eat away at Netflix's market share.
That may be the case, but they are weak competitors when it comes to financial operations. Paramount is, in our opinion, in trouble in terms of its earnings and the ability to fund its streaming goals. Disney as well. It mentioned that there's problems in its linear business. It's looking how to spin out ESPN. It now carries much larger debt load. The only successful company in streaming is Netflix. People, I speak to clients, prospects. They don't think, they hear that Netflix is not profitable. Nothing could be further from the truth. Netflix is going to generate over $5 billion in free cash flow in 2023. It has won the streaming war. The game is over, and now we expect the valuation to continue to stay at high levels because of the quality of the business and management.
Okay, let's move on to Alphabet. You own this one as well on behalf of clients, and I gather personally as well. Is that correct?
Absolutely.
The parent of Google.
So, a few months ago, everybody was worried about Google and AI and how ChatGPT was going to impact it. And then, of course, the narrative has switched. Google has caught up. It's releasing its AI and chat tools, and there's more to come. But at the end of the day, if you're looking for technology profitable companies that really are still attractively valued, Google fits the bill. It's trading around 20 times this year's earnings. We've come out of a little bit of a lull in terms of advertising budgets. That has to rebound as the economy starts to improve here. The balance sheet is absolutely perfect, over $100 billion net in cash and generating unbelievable amounts of cash every single day. As they continue to monetize more and more of their revenue streams from cloud, from chats, from AI, we just see the stock as one of the cheapest in the big tech space.
Okay, and Live Nation, perhaps a less well-known stock, but we know it as the big concert promoter. You like this one too? Yeah,
in the news over the past few months, a lot of the U.S. regulators were concerned how they mishandled the Taylor Swift concerts and pricing. But when you do a deep,
Ticketmaster is owned by Live Nation, correct?
You got it.
Right, okay.
So they have the best relationships with all the top artists around the globe, as well as selling the tickets through Ticketmaster. You put those two combinations together, it's a flywheel of growth. The opportunity outside North America is tremendous. Lots of people attend concerts in North America, not so much around the globe. Mm-hmm. It's trying to increase the amount of festivals and concerts. It's also buying actual concert halls in Toronto. It recently just bought the Opera House right here on Queen Street. Mm-hmm. It also purchased the Key to Bala in Muskoka. Concerts are an experiential spending, and as people, we've already bought the patio furniture, the new TV. Now we want to go out and enjoy life, as the COVID issues recede, and this is a great way to play that. Those of us who do attend concerts know that post-COVID, there has been a big pickup in the amount charged for ticket prices. Concerts have become big name concerts have become a lot more expensive. $200 is a very typical price now to see a big name concert. And that's based on supply demand, and we always have to keep in mind Live Nation does not set the ticket pricing. That's between the artist and the artist management, and they'll charge what they want because the artists don't make money from Spotify. They don't make money from anything else but touring. Live Nation makes its money on the fees that Ticketmaster charges to move those tickets. That is correct, as well as sponsorship, as well as if it owns some of the venues, it'll make money on parking, on admission, as well as charging for merchandise. It loses money on every single concert. It loses money on those Taylor Swift concerts, but makes it back on other ways. Barry, thanks a lot for this. Thank you. That's Barry Schwartz, Chief Investment Officer and Portfolio Manager at Baskin Wealth Management.